Okay, good afternoon, everyone. So, yeah, I'm kind of busy with some things, but I want to get out this video on position sizing with Kelly Criterion. Of course, this is kind of an impromptu. I said I was going to make it at 9 p.m. Eastern time, but there are things that I have to do that are kind of urgent. So this is an informal presentation on position sizing with Kelly. Kelly Criterion is a risk management tool used to identify or optimize the right allocation amount for a specific instance where risk is involved. Okay, there are previous recordings here that you can review, but I think today's presentation will have some updated information. So every information that's presented in these recordings, they kind of get better. I think they kind of get better and better over time, but because these are informal presentations, so all of the information that I kind of talk about is not going to be, presented because I didn't create these presentations in a formal format. But let's begin. Okay, so Kelly Criterion is super important when you're using risk, okay? Whether it comes to sports betting or just general risk management, you need to understand why and how. Okay, so in day two, we covered the ideal setup. That ideal setup helps you identify filter out high probabilistic trades so that you're able to build some sort of confidence in identifying a setup that's going to work for you. And then after you continue repeating or finding these setups, you can kind of have a feel for, what works and what doesn't work. And then also then move into learning how to read the futures and then the market internals to enhance your trading experience. And then from day two, once you've kind of grasped the concept of what an ideal setup entails, we talked about the Darvish channel, yellow D, purple D. We talked about TTM squeezes in terms of cycling, because sometimes when you cycle out of a position on the third and fourth position, it kind of pulls back. Maybe the market pulls back really sharply when the trend is high. We talked about a lot of things in the ideal setup, and that's the most important part in becoming a better trader, not only just through common shares, but also when you're dealing with options. Options are, as you know, they're highly leveraged, and you need to have some sort of process. And I believe that the ideal trade setup on day two is a great filter, which will help if you just kind of stick with that for at least 21 trades. Like, just kind of convince yourself or challenge yourself to just do 21 ideal trade setups and then record it. You'll actually be surprised that you're going to be making a lot more winners and profitable. And then you'll probably have to figure out, you'll probably see that you're making profit on most of them, but some of them kind of would have made more profit had you held on to a little bit longer. And then some of them kind of moved really fast. So you could have kind of used some cycling analysis to kind of optimize that. The market is very tricky, and you need to kind of have all the concepts and grasp them to the point where you really own that trading approach. And you don't, the nice thing about the day two is that you don't really need to draw any lines. Okay, it's all drawn for you. You just need to find that ideal setup. And granted, you're not going to catch all the moves, right? We're going to have to be, no one's 100% perfect, but what we want to do is just kind of be consistent with our approach. And of course, you can take all the trades that we produce, but you want to also you want to take those trades with a critical eye, at least understand why you're taking that. So you want to go over day two thoroughly and master that. And then again, the whole point of onboarding is just to, get your net liquid to double so that you have profits. And then during that time, as you grow your net liquid to double it, then those profits can be used to taking some more aggressive trades where you can make some big exponential returns like we had in Roku. So Roku was a campaign that we run here at Toss Option. It's the TGIT, and we've just been milking it all the time. And for someone like me who's always kind of teaching people and also trading at the same time, there is a duty for me to kind of make sure that we were doing it in a manner such that people are learning and trading and having fun at the same time. However, when we finish off a campaign, right, then essentially you kind of graduated. When after you double your account, you kind of graduate, and you should have mastered, or have a good understanding of how this TGIT works. And then when the next TGIT work comes around with some profits, right, when you have profits in your account, then you can take a shot at some big nice trades like we had last week in Roku that moved up like 12%. Okay, so it's hard for me to teach these things while there's new people coming in, and then also people who've already made profits in the campaign. So we could use those profits for some of the other trades. But the whole point is just to kind of make sure that everybody's on the same track in terms of identifying the ideal trade setup, and also then risk managing. And then on day 4, we'll talk about profit taking. All right, so today's day 3, we're going to talk about Kelly Criterion, and we're going to go through the main assumptions. So the main assumptions are things that you just have to kind of just accept. Like there's no way around it because of the uncertainty of what the market does every hour or every 30 minutes. We just have to make an assumption. And lots of people make assumptions, and most of the time the assumptions are wrong. But when we have a market that's kind of repeating over and over again, these assumptions kind of play out to be happen quite often to be true. And we want to identify those assumptions before getting into Kelly Criterion, which is the risk management concept that is taught in graduate courses, and why we should care. And then we'll talk about the number of entries per week. Okay, so I think number of entries per week is great because it gives you an idea of, as an option trader, how many trades theoretically you should be making over the course of a year, and then putting it all together at the end of the slide. Okay, so let's just move forward here. So main assumption 1, this is the first, let me see if I can put this on a presentation mode so I can mark it up a bit. Yeah, how did it do this again? Switch display. There we go. And what color should I use? So here we go. So main assumption 1 is to understand a specific strategy and setup. So at toss option, we have setups. And that's like BLT, ET, candle over candle. Any other setups? Oh yeah, we got wolf waves. We have short squeezes on the, we got a kicker, right? Kickers are powerful. These are setups. Okay, and you need to know what they are in order to be familiar with the type of risk you're willing to take. And then we have strategies. I guess another setup would be the ideal setup, right? So the main assumption is you need to know all of these setups. If you don't know, then you're not going to become the best trader in the world. If you don't know, you can type in the Discord room, for example, right here. Go to the main room, and then you can just type in like /BLT, and then you get an example of what a BLT is. Okay, it's great. Bacon, lettuce, tomato, classic. And then strategy-based trades that we use for the onboarding is TGIF, TGIT, and then like maybe a D-ball long, maybe 10 seconds. I guess 10 seconds into the close. Yeah, D-ball is one, momentum-based. And 10 seconds into the close. All right. Now, how do you know the difference? What's like, some people might, and feel free to ask any questions about Kelly Criterion, because the more you understand it, the better you're going to become in managing your risk. As I mentioned before many times, we are humans, and time runs out for everybody, no matter who you are. And because of that, we take risk. It's just what we're designed to do, right? And when you take risk, then the only thing you can do when you take risk is really to manage that risk. And how you manage it is based on your experience. And when you manage it properly, you're rewarded with small drawdowns and profits. That's it. Okay. If you don't manage the risk and you let it go to worthless, right? And depending on the allocation amount, then it could be a managed risk position that goes worthless, or it could be a full position that went worthless. And if you don't manage it, then the market will manage it for you for free. So make sure you know how to manage your risk. That's your job, not guessing if something is going to move up higher. So the guessing part is removed when you identify the setup. So guessing is removed when you consider these things, right? Because we're letting the dice roll, and eventually 1 out of 6 times we're going to hit a 1, right? Which is not the greatest odds, but eventually when we roll it a couple of times, maybe more than a couple of times, we know we're going to get 1. Okay, assuming the die is not a biased die. So when you feel, or you come into the room and you hear people saying, I feel this is a good setup, I feel this is this, I feel that the company is coming out with something, and all that stuff, that's a lot of feeling that we kind of try to eliminate. We want to just identify the setups, and I guess between the strategies and the setups have a lot more feeling associated with it. However, they're clear setups that you can identify when it's developing. And then strategies, between strategies and setups, strategies have a little bit more of a back testing history. Okay, it has time histories associated with a specific ticker, and we have an output of returns, and then we also have seasonality associated. So strategies have a little bit more information, whereas BLT setups is limited. Okay, so there's I would almost say that setups are more discretionary and strategies are non-discretionary, anti-fragile. Okay, and that's the whole point in anything you do. Like when you go play soccer, when you go play any sport, you want to have like a strategy, right? Where for baseball, basketball, whatever sport you're playing, you usually come up with a game plan, right? And then you set yourself up, and then you execute the plan as outlined by the coach. So strategies, without strategies, right, then you're going to be and you're just doing everything freestyle. You're going to be subjected to whatever the market is going to judge you. The market is going to judge you on that approach. When you go and fight battles with other teams, you practice, but you're not practicing just like for soccer, you're not just practicing kicking a ball into the net. You're practicing strategies when you have certain case scenarios playing out during the game. So without a strategy, then you're not going to really do very well long-term wise. And the hard part also is the FOMO. Okay, and then we'll talk about that later. So when you identify strategy or setup, this provides the traders a clear understanding of your POS. And POS is not a piece of shit. It's a probability of success. Okay, so you need to know that concept, the probability of success. And most of the time when you get a BLT, the probability of success is not quite clear because we don't have histories to kind of show what that type of setup would look like. We just can take an educated guess that this is what we assume is going to be moving forward, as long as the market is, in moving in our direction. But strategies, they do have a probability of success, including, you know, seasonality and all that stuff. There's a lot of details in strategies. Identifying a strategy in a setup allows traders to predetermine the allocation and amount for that specific strategy and setup. So what that means is that, where is this pin? So what that means is that the allocation amount, so if I have a strategy that I know that works, then I'm going to buy like 10 contracts, okay, at a cost of like $1,000, which could be, you know, 10% of a $10,000 account. And then a setup based, using a different net liquid, could be maybe 2 contracts, depending on, you know, which month of the year we're in, which day of the week we're in, and the cost. So, you know, the range, the cost varies, right? Depending on discretion, which includes profits. Okay. So the percentage here is user defined. So you go to the casino, you go to the roulette table, and you're like, yeah, it's going to hit red. And you know it's 50-50, right? But you feel like it's going to hit red because you see red popping up a couple of times. So then that's your setup. Your setup is every time it hits red, you're assuming that the ball is lands independent of the previous spin, right? And you're just now making an assumption that the next likely color based on the trend is going to be red. And that is still going to be 50-50. So you can't say I'm going to put $1,000 on red when, you know, the odds are 50-50. You come up with some number based on the number of chips you have in hand. And if that number happens to be all the chips in your hand, that means that you're 100% confident that that red is going to pop up. But that is not the case, right? Because the probability is always going to be less against you. So the main assumption 2 here is the position size is a stop loss built into your net liquid. So this is a concept that's very sensitive, and you know, with options we have different types of option contracts. One that's purely extrinsic based, and one's a combination of extrinsic and intrinsic. So whenever you're trading extrinsic valued contracts that are just out of the money, that's what they call it, then you got to position size such that the amount that you risk is assumed to go worthless, because there's a huge decaying component involved in that. And a lot of people take advantage of that decaying component by selling spreads. But I'm against spreads because it takes too much time. I'd like to, you know, use the tools that I have and take advantage of the volatility and the price momentum. So when you start position sizing, you want to kind of have that idea that whenever you go out of the money, then you're going to make an assumption that they're going to be going to zero. Because if you have a $10,000 account and then you put in 2 contracts that cost like $500, and that's what you define to be your absolute comfort level, then you lose this, it goes straight to zero. Let's say you don't manage it properly and just goes straight to zero. But with that position size, at least that you've defined your risk. And if this goes to zero, then your balance turns into 9,500, which is pretty reasonable like when you're dealing with options. Like a drawdown of $500 on $10,000 account is not that bad at all. Okay, especially when the returns on a position can go up to like 10x. And then for in the money contracts, you would have to assume you'd have to define a stop loss because obviously when you go in the money, the price of them usually is greater than the cost of the OTM. Okay, so this isn't because if you do go in the money, you're going to fork up a lot more risk. However, the probability of success actually increases significantly when you pick these up because they have actual value associated with it, and the decay is a lot less. Where this one has pure extrinsic value, 100% premium, whereas the in the money is a combination of premium plus value, or also known as intrinsic value. Okay, so they call it extrinsic value and intrinsic value. So because the value of an in the money call or put has two components involved, it is recommended that you use a stop loss when you get into a position that has a setup or a strategy related. Okay, and this is very important. I personally don't think if you have a bigger account, then you would use in the money, but you can still do very, very well risking a lot less trading out of the money. But you're gonna definitely have a lot more drawdowns because the theta decay is pretty heavy sometimes. Okay, so main assumption number 3 is open at least 2 contracts and risk and keep in mind of the net liquid. So if you're starting out and you don't know what the number of contracts you need to pick, then you gotta pick up at least 2. If you assume 1 contract, then you're just a tester. You're just tester. Okay, you're just testing out the waters. So in order to actually be trading, you need to manage some risk. So you got to get at least 2. Okay, 2 contracts. And then you also have to keep in mind of the net liquid because, Amazon contracts, 1 contract, can be worth, $3,000. And if you pick up 2 of those, that's going to be 6,000, right? And maybe your net liquid is 6,000. That's 100% your net liquid. So you can't obviously do that. So this is the next main assumption, is that you should open up at least 2 contracts, keeping in mind of your net liquid. Okay, so if those 2 contracts, if we alerted 2 contracts and they happen to be 100% of your net liquid, then you can't get into those contracts. You got to look for a different strike, right? Because it's all relative. Main assumption number 4 is to close half and let the rest ride or go. So this is kind of like risk management or profit taking assumption, but this is the whole point of opening up 2 contracts, is that so you can make, manage that risk and experience max profit. So here, in terms of risk management, once you hit 100% return, then the assumption is that you're going to close 1 no matter what. You force yourself into a position that closes 100% on that first contract, anywhere between 50 to 100%. That's what you want to try to hold on to when you have 2 contracts. So if you have 2 contracts, force yourself to get 50 to 100% return on those 2 contracts, and then close 1 contract. This is the assumption that you're going to do. This is not a technique. That's the assumption. We're all going to assume that you open up 2 contracts minimum, at least, when you open up when you find a setup or a strategy. And when you do that, you're going to force yourself to hold for those 2 contracts and determine between the ranges of 50% to 100% return. You're going to force yourself mechanically close half. Mechanically, let's use that word. Okay, it cannot be, there's no negotiation. There's nothing. Like your thinking process of 50 to 100, once you see it, sometimes it happens really fast. Sometimes it happens really slow. But once you see that profit, you got to force yourself to close off that contract without thinking too much. It's just part of the game. It's the assumption that we are using in this room. So when you get into a position with 2 contracts and all of a sudden, boom, the positions are up 50% to 100%, and you didn't close, then you didn't understand the main assumptions, right? It has to be mechanical. It's like, oh, damn, man, I was in the washroom taking a piss. I missed this trade. No, you should put a sell limit order there for 50% at least, right? Whatever you do, you got to make sure you're closing that position with some sort of profit between 50 to 100%, such that the remaining contract becomes less of a burden in terms of your risk, okay? And that's just part of the risk management in Kelly Criterion. And then the other assumption is once you go into advanced level, you would figure out how to close different percentages based using the trend. All right. These are assumptions that are not part of the Kelly Criterion course. These are assumptions that you must make. You must own these assumptions. You're assuming, even though we make assumptions and they tend to be wrong, these are the assumptions that you should really adhere to. They're almost like rules. However, why they're assumptions is because markets change day to day, and you can interpret them, interpret the market internals to give you allow you to make assumption number 5 worth your while. But that's the last assumption, is that if you open up 2 or more contracts, so let me just write this out. So i.e. 10 contracts, then obviously you can follow a method of the previous method where you close off half. So you open up 10, close off 5, and then the rest of the 5 is pretty much free. Or under certain circumstances, using the market internals, you can make an assumption to close up to 80, 20, 90, 10, 70, 30, 60, 40, 50, 50. Now you've got some options on various assumptions, okay? So 80-20 is probably the best, and we call that a Pareto distribution. Obviously, there's different types of distributions that you can select from: 70-30, 80-20, 90-10, 60-40, and 50-50. 80-20 is the optimal, okay? Just putting it out there. All right, so now we're going into the specifics of Kelly Criterion and why should we care. So Kelly Criterion, like I mentioned before, under main assumption 1, is that you need to know how to optimize the number of contracts you pick up, because if you don't, then you might be making too little, or you might be making too much, which is not a bad thing. Making too much money is not a bad thing, right? But then what happens if you get hit on one of those big trades, right? It'll wipe you out. So you want to make sure that you understand the Kelly Criterion is a method. Let's look it up on the on the webpage here. So Kelly Criterion. So it's a scientific gambling method. It's a formula for betting size that leads almost surely to a higher wealth compared to any other strategy in the long run. Okay, the Kelly bet size is found by maximizing the expected value, okay, of the logarithmic wealth, which is equivalent to maximizing the expected geometric growth rate. Okay, so what this basically means is that using a strategy, they call it a strategy of risk management, but we'll just assume Kelly Criterion. Kelly Criterion is a method of, is a function, is a criterion that allows you to determine the allocation amount that is optimal to generate the profits that you're looking for. Okay, the profits that is defined by the profit factor of a specific strategy or a specific setup, where setups can end up becoming like 10x moves. We don't know, right? But that's what Kelly is there for you to do. It's going to help you optimize the amount, the position size, such that you are able to get into a model that's going to generate huge profits. So when we go into Kelly Criterion website, there's a website from Pinnacle. Pinnacle is a sports betting website. You can get this link here. I'll post it here for you guys to kind of look at. Oops, that's not right. Let's get that link here, copy. And this author here has provided a nice description of what Kelly Criterion is. And basically it comes down to this formula. Okay, so decimal odds is the letter B. So if you don't know what the decimal odds is basically the return on your investment when you risk one. So for example, if the decimal odds is 2, then 2 minus 1, there's that 1 right here, right, is 1. So then that means you risk 1, which is this one, this number right here. And you subtract it from 2, then you get 1. That means you risk 1 to make 1. That's 100% profit. So 2.0, the decimal odds is 100% profit, right? So that's letter B. And then probability of success is the letter P. And that's the strategy, right? You need to know what the strategy is such that you can determine that the input parameter here. Okay. And then probability of failure is just the inverse. So this is the formula when somebody, if you go to another trading room and the trading room says, hey, you got a position size, you go, oh man, I blew up my account. And then, obviously the answer is, oh, you got a position size. And that's what they'll tell you to do, but they don't tell you exactly what it is, okay, how to do it. So position sizing is, first, you need to determine the return on your investment, right? So let's say you go into an option trade and you're getting like 10%. Would you really put in that risk of $100 to make 10%? Okay, probably not, right? You want to increase the decimal odds to make it attractive enough for you to take some risk, right? It's not worth it if you're just making $1, risk $100 to make 1%. That's not fun, right? And after all the commission fees and stuff like that, you end up losing your money, right? So you need to make it worth your while. Typically, it's just decimal odd of 2.0 is the standard. But because of Kelly Criterion's expectation of exponential growth on a logarithmic rate, then you're looking for these big returns, decimal odds of like not 2, but 5, 10, 100, okay? And then the probability of success is based on the understanding of a specific setup under market conditions, under day of the week, under month of the year. A lot of things go into that, but the TGIT specifically is around 62%, okay? With a profit factor around, assuming just 1, just for calculation's sake, right? And then the probability of failure is the inverse. So if you go down, scroll down here, you get the calculator. And let's just say that our TGIF for Roku returns about 2.5. And the probability of success is around 62. So what this calculation does, it explains to you that if you have a return of 150% and the probability of success of this strategy is 62%, then you need to risk 36% of your net liquid. Okay. And you're like, God, oh, you're like, oh my gosh, Roger, that's nuts. I'm not gonna, I got $10,000 and you're telling me I should put $3,000, $3,667 in this Roku TGIT trade. That's ridiculous. And yes, of course, that's ridiculous. Nobody would put that much money. If you had $1 million, you wouldn't put $360,000 on a TGIT, on any given TGIT, right? Because you don't know if that one is going to be the winner. 6 out of 10. Maybe you're on the, you catch the one that loses 4 out of the 10 times. So how do we adjust or normalize this value of 36% such that it makes sense for us? Well, that requires you to do some back testing, okay, to figure out what is required for you to make sure that it is comfortable for your net liquid, for your personal, account. So you take 36%, right? And you just kind of, you have to look at, so let's just take this here and then copy paste this. And then go to the PowerPoint presentation. Where is that PowerPoint presentation? Right, it's here. And then go to, type that in there. You can go to the link here to look at the rules. But let's assume we have this as our, this is a strategy, obviously, right? So this is an example of a strategy. So let's say that this is, oh, I don't know what happened there. So this is strategy. TGIT. So it gives you decimal odds of 2.5. So 2.5 minus 1 is equal to 1.5. That's 150% return, right? And then through back testing, we figured out that the return, the probability of success is 62%. That's the POS. And then it's saying that we need to put 36% of our net liquid. So that's a lot. And you need to, and if you lose half of that, how would you feel? So you gotta start, you gotta go through the feeling process. Like, are you comfortable with 3,600? And most people will say no, they're not comfortable with that. So what you need to do is you need to first figure out for this specific strategy what the net liquid is. So first determine the net liquid amount for TGIT / campaign. So you need to know what you're going to use for this, and you're going to continue using that amount into perpetuity. Okay. So you say, well, I'm going to use, you may say, oh, Roger, I'm going to use like 10,000. Let's just say you use $5,000. So let's assume an example. $5,000. Okay. So from $5,000, then Kelly is saying you got to use 36% of that amount. right? And you might be saying, well, that's a lot. So what's 36 of 5,000? It's 1,800. Per trade, TGIT. And then you would say, oh, gosh, like, Roger, that's like too high. Because Roger, I'm not like as good as you. And, if I draw down from 1,800 to $900, I'm going to get pretty sad. All right. Well, then you go, okay, well, when you follow the assumptions, let's say you're going to close off that position at 100%, half of them. Let's go back to our assumptions and say, okay, well, hey, don't worry. You don't have to feel you don't have to be so ballsy here and put so much risk. Why don't you just close off half at 100%? All right, well, Roger, what do you mean? You said 2.5. 2.5 is the average return. What are you going to actually do? Let's just go to 2. So now you go to 2, and then now the probability of success, the percentage drops from 36% down to 24%, right? So $5,000 times 0.24 is 1,200. This is decimal odds 2.5. Whoops. And this is decimal odds 2.0. And that equals to 1,200, right? And you're like, okay, Roger, like I can handle like a $600 drawdown, right? What's the average drawdown? Well, it's 50%. And you say, oh, and then maybe there's another person who's like, oh, Roger, 50% drawdown on 1,200. That's not good enough. Is there anything else I can do? Like, can you change it a little bit? And I said, yeah, change it. Drop your position, drop your net liquid down to half. And then see if this value works, which would be 600, right? And then when you take this number of $600, and then we go out there and get those contracts, like the $500 calls for $1.50, how many can you get with $1.50? So you can probably get 4, right? So you get 4 contracts using a $2,500 account. And that's how you determine your position size, based on your feeling, based on your tolerance, based on your campaign. You can't just like have like a bunch of money in your account and not go through this process, right? You got to go follow those main assumptions and then go work through the numbers so that you understand that, people lose money and your positions will draw down, but you got to find that number that resonates with you. And that's what Kelly does, helps you. Okay. Does anybody have any questions about this? Because this is like very, very detailed way of calculating your position size based on you. You do you, right? I cannot force you. If we finish off campaign 1 with $7,000, $9,000, and then somebody new comes in, right? Maybe that person who was in campaign 1 wants to assume a $5,000 net liquid and assume a 0.36%, 36% stake, which is 1,800. Of course, with profits, you can do whatever you want, right? That's money that you made. However, if you're not in that case, if you're not the person that's in making that profit and you feel a little bit, uncertain, which is okay because you have to embrace the uncertainty. Nobody asked to be born, and nobody knows when they're gonna, pass away. So we have to embrace the now, right? We have to embrace what's given to us now. And what's given to us now is your net liquid and the probability of success. And what we don't know is whether or not that specific trade out of the 10 trades we're going to take, is that going to be the one that, moves up 12% or 4%? Unfortunately, we don't know. And we can only manage the risk because, like I said in the beginning of the presentation, if we take risk, because we are humans take risk. I don't think I've seen some people who don't take risk, like some scary cats. They buy, they wear a mask and then all that stuff, which is fine, right? They're just managing the risk. But if you don't take, but they're still going out, right? If you don't take risk, then like, how are you going to be making profits, right? How are you going to get rewarded if you don't get rewarded for not taking risk? You got to take risk, and governments embrace that. When you open up a business in your state with an LLC, whatever, governments give businesses the benefit of the doubt because people who are opening up businesses take risk. So you get tax incentives, whatever incentives. So when you come into options and you figure out what your risk is going to be, you got to calculate it based on these rules that we have prescribed and the strategies, the back testing we have prescribed using seasonality, which month are we in? January is the best month of the year, right? And then we got earnings seasons as well. We know that TGIT, buying Thursday, buying Friday, holding over the weekend, most of our profits are coming from Mondays and Tuesdays, or sometimes Thursdays into Fridays. These are things that you have to understand. But then when it comes down to taking risk, it should be all already predetermined because you went through the exercise. You know what your net liquid is. You're creating campaign. You want to do TGIT. You want to do some BLTs, and you gotta separate the money so that you got to think of them as businesses. Okay, TGIT is my Costco. I like Costco. This is my business, Costco. We do wholesale. So I'm gonna invest $5,000 into Costco only trades. I mean, I don't know if that's the great example, but like, what I'm saying? Like, if you're gonna open up a business of a shoe store, a restaurant, and a coffee shop, you think of your shoe store as your TGIT, your coffee shop as your like maybe TGIF, and then your whatever shop as your BLT, whatever, right? And then you know exactly how much it costs to be in that trade for that specific campaign. Okay, there's no guessing. You already know what it is. If it's a BLT or an ET, then you're like, okay, well, this is what I determined the ET to be. I'm going to assume 2 contracts, and then it has to be under, $300, whatever, right? That has to be all figured out before you start trading, because that net liquid, like I said, in the Discord trading rooms, nobody knows. Like when you sign up and you pay us $100, what is the first thing that the trader's thinking? They want to get into a trade and make money. Okay, so how many assumptions are they not understanding when they just think like that? Their assumption is only making money. But did you know that making money involves taking risk and managing risk? So that requires you to understand position sizing using Kelly Criterion. And when you do that, then you are now a trader because you know exactly what trading involves. Entails position sizing, and entails figuring out the decimal odds. It entails you to take trades with a probability of success. Obviously, we can never ever assume 100%, right? Hindsight is 100%. So after you make like 300, 400%, you're like, yeah, it's 100% return. It's 100% guaranteed money. I can't think like that, right? Nobody knows. So that's the exercise for calculating your position size. And that is something that you got to, sit down, grab a cup of coffee, right? And then look at your balance and say, okay, I got $3,000. And then I want to split this up for like, 2 specific trades, or do the onboarding, whatever. And I want to double my account with it, sticking to only these trades. It's like a business, right? So if you're in the business of selling socks, and you want to just pick up, the socks that sells well, the black ones and the white ones, right? And maybe you want to take a little bit of risk of buying the Mickey Mouse socks because you got some kids coming in now and they want to buy those socks. So you don't buy all the socks of Mickey Mouse. You buy maybe 2 or 3, see if they sell. These things you got to figure out, because if you don't figure this out and you keep on taking the number of contracts that are coming from RS and bags, you're already losing at that moment. So the investment starts here by understanding the Kelly criterion is a function of probability of success. Once you figure out your probability of success, then you can determine your allocation percentage of your stake. And then you have to make some bigger assumptions like, okay, like feeling assumptions like, okay, if I take 36% of my 5,000, am I comfortable with $1,800 draw, 50% drawdown in $1,800 account? And maybe most people will say no, right? And if you say no, maybe it's because you're not applying a lot of the tools that we're using to kind of identify that it is a trade that could, move up 12% that day, or whatever it is. But that's a different story. That's to identify whether the trade is going to be in your favor or not. That's not covered in this course. The course today only covers why you should use Kelly criterion, because it optimizes your return on your investment, and how to calculate it. So I just went through each and every step using a TGIT. Now, if you're going to use a BLT and all that stuff, you wouldn't use 62%. You'd probably vary it from 50 to 54 to 67. Okay. But 67 means you've understood a lot of the other things that most people don't grasp, like maybe kickers or day of week or seasonality, whatever the setup has in it. The more setups that it has, the better maybe the percentage or the confidence in the discretionary trade that you're taking increases. But that's a different story, right? So that's it for today for Kelly criterion. Does anybody have any questions about it? Did anybody think this is useful? If it's not useful, maybe if you think it's useful, maybe raise your hand. If it's not useful, then don't raise your hand. No, yes, no. Okay, so it wasn't useful. Some people thought it was useful. And we keep in mind this risk management stuff, Kelly criterion doesn't only apply, it actually works in the casino. And I don't want to talk about these other strategies I have for the roulette table. I mean, it's amazing, but you can apply this risk management approach to anything. You gotta know what that strategy is. And then once you figure out what that strategy is, you can work around, use those numbers to kind of help you understand what kind of risks are involved. Now, if you're just doing this exponential derivative stuff with options, right? You blow up account, you might have to think about how much risk you took, right? Maybe you went in too deep, or you over position sized. And when we take a look at the TGIT record here, see that right there? When I started that campaign, and let's just say I used $5,000. Well, in this case, I used 10, right? Then that could be $10,000 of a $100,000 account. So it's 10%. So I've said, okay, I'm going to allocate 10% for this TGIT. And then from that, I defined 1,500, 15% using the Kelly criterion. Now, if I drop it down to 5,000, right, then the profit ends up becoming, I can't really do that because I need to figure out what this one is summing up to. Anyways, you get the point, right? You just this number right here is the number that you need to figure out, and then you got to figure out the position sizing, And then once you do that, you can take some really big hits here. We took a big hit, and we, you can see the drawdown here, and it happened again in the last TG in the second campaign, starting in July or June. See, we took a big hit here. We went down as much as about $1,000. We made 2,000, and then we give back all the profits, and then now we're back up to 2,165. If we manage this risk a little bit better, we wouldn't have dipped so hard, and maybe we'll be at 2,300. Okay. And I think some people actually did that. Some people, I think it was, if my memory serves me right, Pong, who's there on the listening, he closed the July 23rd contracts, $500 calls at a stop loss of 40%, and good. Maybe 40%, maybe 40% is a little too tight. You'll have to do some parametric studies to understand whether 40 or 50 is better. But essentially, Kelly Criterion will protect you such that even if you do let one position go to zero, you're still in the game. And then if you remember, I don't know if you were in the previous campaign, after you build up that profit, and now you're up at $8,000, and then you start the next one, right? Maybe you decided to do $2,000 position here for the last week on Friday when Roku did the 12% move, then we would be up probably $5,000-$6,000. So these are all things that we don't know exactly. We can kind of sense the setup is going to give us a 12% move, but overall, like a strategy versus a setup, these are clearly two different approaches to trading, but they're both very, very important in how you determine whether something is going to be something that you're going to take a little bit more risk than two contracts, because taking two contracts on a setup is kind of boring, right? So then maybe obviously with the strategy, and then you already have predefined the strategy with 1,500 for this case, right? And then you're like, okay, this Roger guy seems to always tell me about these BLTs and ETs, and I see a BLT ET going into this TGIF or TGIT. So maybe, I feel good about it. I know exactly how this looks, and it's trading above the 6-day moving average with an RSI that's over 80, which means it's overbought. But Roger told me that overbought means buy signal. Then, yeah, I'm going to maybe up it up a little bit to 1,700 and see what happens on Monday, because why not? Most of the money I may be making has been on Monday, right? But using profits, right? With the Kelly criterion of 15%, you're doubling your count first. And that's the whole point of the onboarding process. After you double your count, then you should have enough experience after how many trades? 30 trades to know exactly, now you got the feel for it. And then now you got some profits, and you're like, okay, I know BLT. Rogers showed me BLTs many times. I know the ideal setup. I see a nice ideal setup, and I want to take it. I have some profits from the last campaign, and instead of putting $1,000, I want to put in 1,200. And if you do that, you're gonna be, then at that point, when you do all that thinking and you actually put in a little bit more risk, you have actually learned something from me, and you have built, that's your first day of confidence. That's a confidence builder right there. All right, so moving forward, quickly, the theoretical number of the absolute minimum that I would recommend is 825, based on an $825 per trade basis. The theoretical number of trades per year is around 52. So 52 weeks per year, right? I'm just following a TGIT approach, but there are a couple of stat holidays. So we dropped it down from 52 to 40. So essentially, in theory and realistically, you should be taking about 40 trades per year. 40 trades per year doesn't necessarily do you take 40 trades every single week, once a week. You can compromise to take 2 trades per week or 3. It just means that you're running out of trades for the year. Okay. In theory, you should be taking 40 trades. So obviously, if you take 40 trades in one day, you've literally exhausted the number of trades you're allowed to make per year, right? So you want to be a little bit sensitive to that number, how many trades you're going to be taking, which month of the year, which day of the week. This is important because this is how markets work. We always talk about markets on Wednesday and how Apple always drops. Why would you buy, if you know Apple keeps on dropping, and why would you buy calls? Maybe you buy puts, or maybe just avoid trading on Wednesdays altogether, especially if there's a Fed, right? So you save one trade. You only have 40 trades per year, realistically, as a beginner. And then once you become better and your net liquid grows and you're able to take positions with more than $825 per trade, then maybe now you can up the number of trades from 40 to 80. But keep in mind, you can increase the number of trades from 40 by dividing 825 by 2, right? That's 412.5. And that will increase the number of trades from 40 to 80. So there's always a way to kind of manipulate the relationship between the number of trades to the dollar amount. But keep in mind, this is just a model that you should always kind of keep in mind to prevent that FOMO. So if you got that FOMO, you're like, God damn, I want to get that trade, but I don't want to risk like 825, which is my normal position size, then divide by 2, or just get one contract, but make sure that contract dollar amount is less than what you prescribed when you have a setup, because you might be chasing that time on a trade that's on news, and you can't really chase it with chasing something and you're fast enough to identify if it's an ET or a BLT, then you would know like what number of contracts you should get. But if you don't and you're getting itchy, then you need to know that you need to adjust some things on the fly. Can't be thinking, because it all has to be predetermined, right? All right. So anybody have any questions before we end this session? Tomorrow will be risk profit taking, but it was kind of discussed here. But okay, we got a question from iPhone. I'll unmute you. All right, go ahead and unmute.
Hello. Roger, a question for you. This is
Yes.
Chirag. So for the Kelly criteria, understood for the TIGT, what is for the setup? Like, I know we want to do a setup like BLT or kicker or something.
Yep.
What probability of success we should put it inside?
It ranges between the day of the week, month of the year, but it would be ranging between 52% to 60. Let me see on the Discord channel. I wrote it down here. Under day 5, it ranges from 57 to 81%.
Okay.
Okay, so there's no, and then the reason why there's a range, because it's the seasonality. So it depends on the month of the year and the day of the week.
So when we are calculating the Kelly criteria, depending upon your risk tolerance, you should always go with the lowest number?
No. The lowest number is, I guess that would be good for conservative, but
okay,
it all depends on the day of the week, month of the year, and also the market, like the market conditions of the trend. The trend will help you kind of improve the range so that it's not so wide. The market internal.
Thanks.
So if the VIX is dropping, it's negative and dropping like 10%, then it's not going to be 57%, obviously, right? It's going to be higher than that. And then the next question is, what's the decimal odds?
Yeah, decimal odds.
Because if you don't have that, then it's pretty much not worth the trade. So it's 100% usually, 50 to 100%. Okay. But good question. Thank you very much. Did you have any other questions?
Only for the trend, a little bit confused with the trend. So whenever I hear your and the voice, you said when the trend goes above, like it's higher, usually the market is bullish, right? Or if it goes down, how should we know what about the trend?
Yeah, so the trend course material, I will be, I'm almost finished it. And but just to answer your question quickly, if the trend, so the trend has two capabilities. It's a market internal. That's when you go to the exchange on the floor, you'll see a big board that says trend. They all follow it like a god. Okay, and if the trend has two capabilities. One, it's predictive of the intraday action, and it also has predictive capabilities of the subsequent day action. If the trend is higher than 1.5 right at the beginning, then most likely the market will pump really hard for the first 30 to 60 minutes and then chop and then fade into the close. When the trend drops, when the trend moves up and creates a specific profile, which is discussed in the course, where the trend is above 1.5 to 2 to 2 to 4, 2 to 3, whatever, then obviously it's a range that it's a ratio of a ratio, and it very rarely exceeds like 5 or 6. It is always within 0.5 or sorry 0.35 and 5, well within 3 most of the time. So when you get this profile, which is going to be discussed in that course, and the trend is very high, then the probability of the market going to rally the next day, in the next 2 days, increases significantly.
Thanks, Roger.
All right, thank you. All right, we've got another question from Fahad. So let's ask Fahad. I'll ask you to unmute yourself. Go ahead, Fahad.
Hello, Coach.
What's up, Fahad?
How you doing, sir? So I had a question about the 6-day moving average.
Yeah.
You saying what time frame do we use the 6-day moving average?
So Thinkorswim uses Thinkorswim uses the 6-day moving average, and when you change your time frame to a 5-minute, the Thinkorswim platform will keep the 6-day moving average in place, so you know exactly where it is when you drop your time frame to like a 30-minute to a 5-minute. If you use a 6 moving average, then whatever time frame you use is a 6 moving average with respect to that time frame. So it's an apple and carrot example. You want to always have that 6-day moving average being plotted on every single time frame as you shift. Does that make sense?
Got it, Coach. And then thanks for answering that question. Second question I had was UTL.
Yeah.
So if it's extended from UTL upwards, right?
Yeah.
That's not a good time to buy calls, right? You want to make sure. Yeah. So you want to make sure when it peers through, that's the best time to buy calls.
You can. One way is when you see an algorithm going in a short squeeze. We saw a short squeeze in Bitcoin today. So a lot of the algorithms like Coin and Riot, they were selling short those companies, and then they went from red to green because it was trying to close positions, but everything was ripping up. You want to try to anticipate, like if you do a mean reversion when things are extended away from the UTL, that's a strategy, and because you know where the target is, right? It's like if the UTL is at $50 and Coin is at like 75, then you know that there's a $25 profit to be made, right?
I understand.
But so then when you get into a trade that it pierces through the UTL coming from beneath or below, then usually, because we're assuming 80% bullish and you're coming from underneath, a short squeeze, then it'll pierce through the UTL, and you want to try to anticipate that move, especially when it was selling short very hard. And then anticipate the price moving toward the UTL, especially at the open, and try to get that 10 seconds into the close before it happens. And then on an ideal trade setup. And then if you didn't catch that, then you can wait for it to pierce and then go long once it pierces through the UTL. But there's also times when the price action just trades right on the UTL, and that's a great time to buy, especially 10 seconds into the close. If it just keeps on chopping around the UTL 10 seconds into the close, is a great, because you don't want to buy something that keeps on chopping for 6.5 hours. You could just wait till the end of the day and pick it up.
Pick it up, and then also, coach, at the end of the day, you also have to look at the trim value, right? If it makes a good profile, right, so it's above one, and it makes a nice profile, then it's a good time to get in calls, right?
Generally above 1.5 with a yellow profile. One is two, not one, above 1.5.
Above 1.5.
So if you ever see a trend go like 5 and you got this nice profile, okay, that means you just wait till the end of the day. Like if you're like deaf and you don't hear anything, you only see like 5 trend value with a nice yellow profile, and it's 9:30 a.m. It's just right at the open. Then you just turn off your computer, come back at the end of the day, 30 minutes into the close, look at all the setups that you have, and then pick one 10 seconds into close. Because in the next 2 days, depending on the day of the week, maybe Wednesday might not be the best, but on Thursdays when the premiums get cheaper, then you can probably get a nice good trade out of that as the trend drops from 5 down to 0.8 to 0.65. So usually you get this nice yellow profile that's super high, like upwards in the 2 to 3 level, and then it creates a nice thick band. And then on the next day, it's expected to drop from 3 or 4 down to like 0.1, which would be everybody's the best trader in the world day. I don't know if you saw the trend profile today, but it looks like everyone's the best trader in the world day. But the only problem is that profile that resembles everybody's the best trader in the world day start developing that profile when it was above 1.5. So that did not qualify that everyone is the best trader in the world day, because since the trend hit 1.5 this morning or 2, that was an indication that the market was going to be choppy.
Perfect, of course. Thanks for answering my questions.
No worry. Thank you. That's a very good question. Okay. Does anybody else have any other questions? I don't know if it's VJ, so I'll ask VJ to unmute. Okay, VJ.
Hey, Roger. I'm new, and it's actually my day 2. I have absolutely no idea what's going on. I'll have to go through the whole. So please pardon me. Excuse me.
Yep. So yeah, if you're new, definitely go through the onboarding. So I think you need to go back to day 0, 1, and 2, especially day 2, which is the ideal trade setup. And then as you learn and see how we're trading, it's good for you to get ready before Thursday, because that's the strategy we have, TGIT and TGIF. So you would want to prepare to open up your first trade using either 1 contract or 2 contracts when you're ready. But you need to kind of go through like the risk right here, because we don't know your net liquid.
Absolutely, will do.
All right, thank you. All right, thank you for your time. And I have 1 position going into 2, FedEx and Netflix with Zoom. And basically, if we take a look at it, that the Zoom position is my largest position. If we look at it together, I just want to show you, with the wolf wave and stuff. I've already posted the wolf wave in the channel, but let's just look at it again. So Zoom here, there's the wolf wave, right? And it's got a target here of a 406. So now I've defined my decimal odds that exceeds 2.0. It's going to be like a 5 to 6 decimal odds, right? But there's this 200-day moving average here that's in the way at 379. Okay, so the only way that is going to be able to push through that 379 is it'll have to have a TTM squeeze. So we do have a TTM squeeze. Actually, there was a TTM squeeze on the 78-minute time frame this morning, right? With not the most ideal trade setup here, but there was a 70-minute TTM squeeze that pushed it higher. And then on top of that, there's a 4-hour TTM squeeze with a nice purple D short squeeze that's pushing Zoom higher, and that could push even higher if it triggers cycle 1, 2, and 3 through that 200-day moving average. And then finally, if we take an actual look at the daily time frame, we do have an ideal trade setup here. That's the yellow Darvish channel. However, the TTM squeeze fired short to the downside, but reversed out of it on cycle 2 and 3. Turn off the Heikin-Ashi candles turned on, so you can actually see that most of the momentum and the price and volume in each of these candles has created a moment of inertia such that the centroid of this candle is higher than the previous day candle. So that allows us to understand that the time in sales from the buy and the sell side was dominated by the buying side today, which is good. And this is Heikin-Ashi candles are great for identifying simple trends. If you use the Heikin-Ashi candle as part of your decision to go long or short, like here it's red, right? So I buy puts, here it's green, I buy calls. That would increase your probability of success on any trade, regardless of it being a strategy or a setup. It'll provide enough conviction for you to understand your what you want to, if you want to take it or not. But let's turn off the Heikin-Ashi candle for a second and go back to the just basic candle setup. So what we can identify here is a kicker. So kickers are very powerful, and I'll show you. This is a kicker on Zoom. However, there's no A6. But if you see the last kicker we were in, which was Roku, see that kicker right there? That's a kicker with an A6. Zoom doesn't have a kicker on an A6, but it is a kicker, but it does have a 4-hour TTM squeeze right there. And it left a little gap that I have to kind of worry about. But the decimal odds shows that I do have a gap right here at 339. So if we can get 339 by this week on Zoom, our contracts will go from $3.20 all the way up to about always go 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7, 750. Okay, basically I just moved the strikes, and that's why we're in Zoom. So Zoom, and then also I think Tesla had a kicker as well. Yeah, into earnings, but earnings is a binary event, so you don't really want to force a binary trade. Binary is 50-50. I think there was another kicker, which was Netflix. No, Netflix was not a kicker. FedEx still chopping, and then Baba. Oh yeah, that's a horrible. Jeez. Yeah. So, anyways, I have my trade for Zoom, FedEx. And so FedEx is just 2 contracts, call and a put that's worth $250 combined. My Zoom contracts at 3,500. So that's the one I have identified the setup that I'm comfortable with. And the decimal odds is around 5 to 10. Obviously, when it hits a decimal odd of 2.0, which is 100% return, I'm going to close off half. And then I have Netflix, which went up to around 30 to 40%. I closed off 8 out of the 10 contracts because the trend hit 2.5. So I was not comfortable, especially watching the Netflix, price action at the open. I was not comfortable holding those positions all the way into the end of the day with the trend being 2.5. So it was a very clean, it was a very quick decision for me to make, just to close those out. And then jump into the Zoom, because the Zoom provided a nice decimal odds that's much greater than the Netflix gap at 530. So Zoom's showing me a target of 390, whereas from a price target of where the underlying is at, that's a 23, almost a $23 move, $20 move, whereas Netflix has a gap at 530 and it's trading at it's at 516. So that's about a $14 move. So I'd rather pick the 20 over the 14. And then Netflix has just been like kind of a disaster. So probably just kind of be careful for that for now. It looks like a bear flag. It does have an A6, but there's just nothing's happening with Netflix, unfortunately. I don't know why. All right, so thank you very much for your time. And I'll see everybody tomorrow morning. This session has been recorded. It does take about an hour or 2 for me to process, but it has been recorded for information purposes. Thank you and have a great night.